If you're 62 years old and you're thinking about filing for Social Security, this video is for you. I talk to people all the time about this decision, and often what I find is that people who are considering or leaning toward filing early are really looking at the problem through only one dimension. And really, there's three important factors we need to consider. I call this the Social Security stress test. And realistically, if you're going to file early, you need to be able to confidently answer three different questions before you file. And if you're not able to answer all three of these questions confidently, chances are you're probably not ready. So in this video, what we'll do is cover some real numbers, real life situation, one where we file at 62, one where we wait until full retirement age, and then a third of if we wait until age 70. And then I'll show you two important components people often miss that can really change the math on the whole thing. So here's our example. Let's assume that we've got Fred Flintstone, who worked a nice long 35-year career down at the rock quarry. He went down there every single day for 35 years. He made an average of $100,000 per year over each of those 35 years, adjusted for inflation. Now, not coincidentally, when the Social Security Administration goes to calculate what your benefit accrual is, they use the average over 35 years of work history. So for Fred, he paid into Social Security for exactly 35 years. He made an average of $100,000 a year, adjusted for inflation. Well, if that's the fact pattern, his primary insurance amount is going to be about $3,200 per month. That's the amount of his Social Security benefits he'll be entitled to. He'll get a check for that amount every single month for the rest of his life if he files at full retirement age, which these days is probably right around age 67. So if Fred files at age 67, he's entitled to $3,200 a month for the rest of his life. He'll probably get cost of living adjustments, and that amount will go up a little bit every year based on the rate of inflation. Now, if Fred decides to file at 62, he's only going to be in for 70% of that primary insurance amount. Every month before your full retirement age that you file, the Social Security Administration reduces that benefit. 70% of $3,200 is exactly $2,240 a month. So in Fred's case, if he decided to file for his benefits at age 62, he's permanently reducing the check that he's going to get every month for the rest of his life by almost $1,000, which is a pretty substantial decrease. Now, he will be collecting more checks because he'll be starting that income stream 5 years earlier. And if he doesn't live very long, he doesn't make it into his 70s, well, he would have made the right decision to file as early as 62 and collect as many checks as he possibly could. But if he expects to live a longer life, well, he might want to wait and lock in a larger benefit amount. Now, as you know, Fred could also wait until a little bit after his full retirement age if he wants to. He can delay collecting Social Security benefits all the way up until age 70. If he does that, he'll get an 8% increase for every year after full retirement age that he waits. These are called delayed retirement credits. So for Fred, if he waits all the way until age 70, which means that he'll be taking a little bit more out of his savings to pay expenses during that time, but he'll be locking in a larger amount, well, he'll be entitled to almost $4,000 a month every month for the rest of his life if he locks in those delayed retirement credits by waiting. So for Fred, his decision needs to be based on a couple of different factors. Well, what other savings does he have that he can use to pay expenses if he chooses to defer and delay his Social Security benefits at least until full retirement age, or maybe even later than that? What is his tax situation? What other sources of income does he have coming in? If you do the math on it, Fred will collect about a total of $618,000 if he files at age 62. He collects a check every single month, and then he lives until 85. He'll collect a total of closer to $691,000 if he waits until 67 and lives to 85. And if he waits all the way until 70 and lives to 85, he'll collect a total of $714,000 or so. The longer he lives, the larger those numbers accumulate. Now, that's the total amount before we do any kind of discounting or adjustment for inflation. Realistically, his monthly check is going to go up by the rate of inflation, and then we can discount it at whatever appropriate rate we see fit. Realistically, the break-even point here is right around age 83. If we're trying to run the math and compare how long does Fred have to live in order for this strategy or that strategy to be better, 83 is about that threshold. So if he doesn't live until age 83, he should not wait until past 67. He should definitely not wait until 70. If he lives until 83, he will have collected enough of these larger checks to make up for those first few years between 62 and full retirement age, where he could have been collecting checks but decided to postpone. So for our circumstances, if you're pretty healthy, you have maybe some longevity in your family, things are going pretty well from a health perspective, you're mathematically probably better off by maybe waiting until at least full retirement age. But again, that depends on a couple of other factors like your taxes, your other cash flow, your other sources of savings that you can draw on temporarily until that Social Security check starts to roll in. So for our 3-question framework here, question 1 is, well, what do the numbers actually say? Like we were just going over, the earlier you file, the less you get. The longer you wait, the more you get. The second question we need to be able to answer confidently is, who else does this decision affect? Because as you know, your decisions from a Social Security standpoint might impact other people in your family. So let's assume in Fred's circumstance that Wilma did not work. They've been married for a long time. When Fred files for his benefits, Wilma might be entitled to a spousal benefit equal to 50% of whatever Fred is getting, limited to the full primary insurance amount. So in this case, if Fred files at age 67, his full retirement age, he collects 100% of his primary insurance amount of $3,200. Well, Wilma is going to be in line for a spousal benefit of exactly half of that, $1,600. Now, if Fred predeceases Wilma, Wilma survives him, Wilma is going to have the option to collect the greater of whatever her own retirement benefit is, or a survivor's benefit, which is 100% of what Fred was collecting. So in that circumstance, if Wilma was raising Bam Bam and whatever the other name of the name of their other kids were, I can't remember at this point, and she did not have any earnings history paying into the Social Security system, if Fred passes first, Wilma will revert back to collecting 100% of whatever Fred was. And so by waiting perhaps from age 62 to 67 or later to file, Fred's locking in a larger benefit, not just for himself and the rest of his life, but probably for the rest of he or Wilma's lives, whoever lasts longer. The third question in our framework here is, well, what does the rest of the tax picture look like? This is relevant. The more money you make, the more of your Social Security income is going to be treated as taxable income, the more tax you have to pay on it. There are a lot of factors at play. What I would comment on here at this point is that the vast majority of Americans are saving for retirement in 401ks, IRAs, other tax-deferred vehicles. And because those vehicles are tax-deferred, you haven't paid tax on that money yet, the IRS actually starts forcing that money out when you're in your mid-70s, whether you want it out or not. And that backs a lot of retirees into a corner as they get older. They have to take money out, even if they don't want to or need it, and they have to pay tax on it at that time. And that often results in higher marginal tax brackets. When it comes to our Social Security benefits, if you have a whole bunch of retirement savings in tax-deferred vehicles, well, your Social Security decision really plays into how you want to handle that. Because if you decide to file early at 62, that means that you're going to have more taxable income in those early years and less room for strategizing around what to do with that long-term tax-deferred bucket, either taking it out a little bit early or doing some Roth conversions or doing some other, long-term tax planning kind of stuff. So another way of thinking of this is if you choose to wait until a little bit after 62, again, maybe 67, maybe later, you're creating a window of opportunity to do other stuff with that tax-deferred bucket. And the earlier you file, the less room you have in those lower tax brackets on an annual basis to maneuver in between, depending on the circumstances. So the number one objection we always hear about this framework, well, why would I ever want to wait? I want to collect as soon as I can. I want to get as many of these checks as I can, not because I don't think I'm going to live very long, but because Social Security is running out of money, right? We've all heard this before. Here's the background. Social Security is a system that's maintained by law, right? There's a Social Security trust fund, and there are trustees of that fund. The trustees are required to report back to the rest of the country on the status of the trust every year. So think of it just like an account. There's money that goes into the account every year from the payroll taxes that businesses pay and the FICA taxes that you and I pay and self-employment taxes. That's the money that goes into the trust. And then that money is invested in U.S. government bonds. They get a little bit of interest on that money. And then there's money that goes out of the trust every year because we're paying retirement and other benefits. So at this point, we have more money going out of the trust that is coming in every year. The balance in that account is going down every single year. And that's what has a whole lot of people around the country fearful, is that we're working the account balance down. Doesn't look like it's going to go in the other direction. And they're fearful that when Social Security runs out of money or works the account all the way down to zero, that the whole thing is going to blow up, basically. The current projections are that we will work the account balance down to zero in the year 2033, which by my math is not that far away. So that part is pretty scary. But the other side of this is when we work the account balance down to zero, it doesn't mean that the system is going to blow up. All it means is that we'll have enough money to pay benefits based on what's going into the account at that time. And at that time, we'll still have people working and paying into the system. And what the actuarial projections show is that we'll have enough money from that point on to pay 79% of everybody's benefits for the next 75 years or so. And for all intents and purposes, if you're thinking about Social Security at all, you're probably not going to be collecting benefits for longer than 75 years. So is there a chance that your benefits might get haircut? You might actually get less than you think you're entitled to based on your earnings and the statements and the calculations? Yeah, that is possible. But I have a hard time believing that's going to happen. Politicians who decide this stuff have a number of things they can do to buffer the system, to get more money in by either raising taxes or the wage base or pulling other levers. Worst case scenario, yeah, maybe we do see a slight reduction in benefits. But I don't think we want to jump to the conclusion here that because the account balance is declining every year and because we're getting pretty close to working that down to zero, that we want to totally disregard the math or by default file as early as we possibly can, because it's a little bit naive. I don't think that it's going to quite work out that way. Now, if you're looking at this situation, you're watching this video and you're thinking, holy smokes, there are a few more moving parts than I was really expecting or really knew about, don't worry, you're not doing anything wrong. You're looking at it the right way. These concepts just tend to have a little bit more depth than we initially realized. There's more to it than just the math of, well, what will I get? 62 versus 64 versus 67 versus 70. We, in our team, in our office, we talk about this stuff pretty much all day, every day. And if you're in a situation where you want a second opinion, you want to talk through some of your specifics with somebody on our team, there's a link in the description. Feel free to click it. You can book a quick phone call with us. We're happy to run through it together. The bottom line here is that in practice, most people are probably better off maybe not filing as early as they can at age 62. Yes, the math can sometimes support filing early, reinvesting some of the proceeds. I've seen arguments like that before. The reality is that the older we get, the more helpful guaranteed income tends to be. And I think, you probably agree with me on this, that in general, life expectancy is going to go up more than it's going to go down over the next 20 or 30 years, which realistically is the time period that we're thinking about here in retirement. So by waiting just a little bit, you're locking in a larger check for the rest of your life. If you're married, perhaps for the rest of you and your spouse's lives, that can be a really impactful thing for families. And that's the conclusion that in practice, a lot of our clients have chosen. Now, that's not right for everybody. Everybody has a personal situation, a personal opinion on the federal government and Social Security. And yeah, if you're convinced that the Social Security system is just going to go away in 2033 and you don't trust the government at all, well, sure, it might make sense to file early. The reality is that everybody's different. In practice, most people that we talk through these items with tends to wait a little bit, at least to full retirement age, sometimes after, to lock in that larger benefit, knowing that they're probably going to live a long time, and we don't really know how long that might be. Those are the three questions we need to be able to answer confidently. Now, if you're someone who's going to decide to wait, the question becomes, how are you meeting your expense needs? How are you drawing income from your assets and other sources during that waiting period before the checks start coming in? So that's the $1 million question. If you're someone who's in a situation of wondering that, we've got another video queued up for you right now that will touch on that exact subject.